In order to be financially stable, it is important to make smart choices about the assets we buy and how we take care of them. Even though assets usually make us richer, there are times when certain types of assets can cause money problems or even cause us to become poor. This note looks at 4 of these assets: high-interest debt, speculative investments, assets that are losing value, and real estate that has too much debt on it. By knowing the possible risks of these assets, we can make better financial decisions and protect our long-term financial security. Let's get started with 4 assets that make you poor. Number 1. High-interest debt. High-interest debt can hurt your finances and make it harder for you to get ahead in life. Interest is one of the most important things to think about. When you have debt with high interest, you pay more interest charges quickly, which makes it hard to pay down the principal amount. Every month that goes by adds to the total amount of debt, making it hard to make big steps toward paying it off. Paying back debt with high interest rates can be very hard. If a big chunk of your income goes toward paying off your debt, it might be hard to pay for other important things or save for the future. The more money you put toward paying off debt, the less money you have for everyday expenses, emergencies, and long-term goals. This can put you in a cycle of debt where you have to use credit cards or loans to pay for basic expenses. This makes the problem worse and makes it harder to get out of debt. Also, having a lot of high-interest debt makes you much less flexible with your money. It makes it harder for you to take advantage of opportunities and reach your financial goals. You might find it hard to save money for retirement, invest in assets that can make you money in the future, or start a business. Your debt takes up a big chunk of your income, leaving you with little room to grow your money or build wealth. Also, having debt with high interest rates can hurt your creditworthiness. If you have trouble paying your bills on time or don't pay them at all, it can hurt your credit score. A low credit score can make it harder for you to get loans or get good interest rates in the future, which can hurt your finances even more. Number 2. Speculative investments. Speculative investments can be financially risky if you don't know much about the market and don't have a well-thought-out plan. Speculative investments come with a lot of uncertainty and volatility, and you can often make or lose a lot of money with them. Speculative investments, like day trading or putting money into startups that haven't proven themselves, can lead to big losses. To take advantage of price changes, day trading involves buying and selling stocks, currencies, or other financial instruments in a short amount of time. Some people have done well with day trading, but it takes a lot of knowledge, skill, and constantly keeping an eye on the markets. Day trading can quickly lead to big losses if you don't know how the market works and what strategies to use. Another type of speculative investment is putting money into new companies or startups that haven't been around long enough to prove themselves. Putting money into early-stage companies can lead to high returns, but it also comes with a lot of risk. Startups often have business models that haven't been tested, limited funds, and uncertain market demand. If you invest in these businesses without doing your research and figuring out what the risks are, you could lose a lot of money if the startup fails or doesn't make as much money as you thought it would. Speculative investments can be very risky because their prices can change quickly and be affected by market sentiment, news events, or other things that are hard to predict. Investors may want to get in because they could make a lot of money, but they could also lose a lot. Greed or fear can make people make decisions based on their feelings, which can cloud their judgment and cause them to make rash investment decisions, which increases the risks even more. Speculative investments are also often not diversified. Putting a lot of your money in speculative assets can make you more vulnerable to concentrated risk. If a certain asset or sector goes down, it can hurt your investment portfolio more than it hurts other assets or sectors. Number 3. Depreciating assets. Things or investments that tend to lose value over time are called depreciating assets. Even though they may make you feel good right away or solve a short-term problem, they can be expensive in the long run. A car is a good example of an asset that loses value over time. When you drive a brand new car off the lot, its value usually starts to go down. Things like wear and tear, new technologies, and market demand can all make its value go down over time. Cars are considered a depreciating asset because their value tends to go down every year. The rate of depreciation depends on things like the make, model, mileage, and condition of the car. Electronics like smartphones, laptops, and game consoles are also things that lose value over time. When new products come out and technology improves, the value of old electronics often goes down quickly. As newer, more advanced models come out, the value of older devices goes down. This makes them less desirable and lowers their value when sold or traded in. Spending too much on assets that lose value quickly can hurt your finances in the long run. If a big chunk of your income goes toward buying these assets, you won't have as much money for necessities, savings, or investments that could make you money in the future. The constant loss of value of these assets can lead to a cycle of spending to replace old things or keep up with the latest trends, which can put even more strain on your finances. Number 4. Over-leveraged real estate. Real estate can be a good investment, but if you buy too many properties with too much debt and rely too much on financing, this is called over-leveraging. This can put a strain on your finances and put your financial stability at risk. Leveraging can increase returns when the real estate market is going up, but it also makes the risks bigger when property values go down or rental income isn't enough to cover mortgage payments, repairs, and other costs. If the value of a property drops a lot, this can lead to negative equity, which means that the loan balance is more than the property is worth. Negative equity can put you at risk of losing your home if you can't pay your mortgage or get a new loan on it. It can also be risky to rely heavily on rental income to pay your mortgage and other bills. Unexpected things like long vacancies, changes in the rental market, or high maintenance costs can mess up your cash flow and put a strain on your finances. If your rental income isn't enough to cover your costs, you may need to use your own money to make up the difference, which can make your financial situation worse. Also, putting too much of your money into real estate limits your financial flexibility and makes it harder to invest in other things or reach other financial goals. Too much debt can make it hard to save, invest, or diversify your portfolio because it cuts into your cash flow. To avoid the problems that come with over-leveraged real estate, it's important to invest in real estate with care and a realistic view of your finances. Carefully look at how much you can afford to pay for a mortgage. Think about the risks and benefits, and make plans for what to do if something goes wrong. By knowing what could go wrong with certain assets, we can make better decisions about our money and keep ourselves from having to go through extra financial trouble. It's important to be careful with high-interest debt. Come up with a well-thought-out investment plan for speculative assets. Think about the long-term effects of assets that are losing value, and avoid taking on too much debt in real estate. By managing our money well and making smart decisions, we can work toward financial stability and build a strong foundation for our future success. Don't forget that knowledge and making smart decisions are powerful tools for navigating the complicated world of asset management and ensuring our financial security.